Welcome to the latest edition of The Bull, the Bear, and You as we take a look at investing and what's happening in the economy. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to be using. A lot of volatility in the markets since President Trump was sworn in. We'll talk about that. Also, as an investor, how should you react to the talk of tariffs and also of eliminating government waste? And we'll have a discussion on consumer sentiment. It is coming up in this edition of The Bull, the Bear, and You. And with me to talk about the economy and investing is my panel of financial advisors and experts, and they are Frank Rossetti of HF Management Company, Michael Godwin of Fergasso Advisors. Two of my regular panelists, Kim Forrest and Carrie Coghill, could not be with us today. So joining us is Shana Bielik of Coghill Investment Strategies. Welcome once again, Shana, to The Bull, the Bear, and You. Thanks for coming. We appreciate it.
Thank you.
You know, there have been more than just a few large market swings, especially since President Trump was sworn in. As an example, in the 14 trading days since the change in power in Washington, the Dow has had moves of 300 points or more in 9 of those days. And there have been 2 big gaps from the previous day's close to the next day's open in both the S&P 500 and the NASDAQ. Now, having said all of that, the markets are close to where they were when the president was sworn in, and all 3 of those indices are still up for the year. So, Michael, we have seen a lot of volatility with little change in direction. So give me your take on what is happening, and is this a time for people to start taking a look at particular sectors, pause for a moment or two?
Yeah, without a doubt, Stacy, some of the volatility we've seen playing out in the markets has certainly been exacerbated by President Trump's rhetoric. I think we saw that play out, was that last week when the market started the day down like 1.5% after Trump talked about imposing broad tariffs on Canada and Mexico. Then, throughout the day, the markets sort of erased all of that loss as Trump ended up delaying those tariffs by a month or so. So without a doubt, he's certainly contributing to that the volatility we're seeing play out. But the other side of the coin is, Stacey, we just came off of two straight years of very, very, very solid market growth, and that was driven in large part by valuation expansion. So we came into 2025 with stocks being as expensive as they've been in probably, I think, two decades almost. And so with stocks sort of priced to perfection, I don't think investors should be surprised when we have periods of volatility that are, very, very elevated right now. And especially if you have some earnings misses or any geopolitical events or exogenous shocks that might happen in the economies. I mean, you're going to see some equity market pullbacks. I think it's going to be the norm in 2025. As it pertains to, I think you asked about, changing in sort of your positioning. I'm one that will never, ever make an investment decision based on what I think a president may or may not do. We see that change so rapidly right now, particularly with President Trump and his decision making. It could change, kind of on a dime there. So that's not something we would ever do as investors here at Fergasso. We would make tactical shifts based on how we think and where we are in the economy and how tariffs, if imposed, and if they get signed into law, how that may impact the overall broader market. But making a guess before that actually happens is not something we're going to do as investors.
Shana, what's your take?
Yeah, I agree with Michael. What we're seeing is very whipsaw, reactionary items in the market, and we're not making any rash decisions based on that. However, if we look at the last 2 years, to Michael's point, we had very strong performance in the market. Last year, 53% of the return came from those Mag 7s. What I find interesting this year is you're seeing that gap close between just general S&P 500 and an equal weight index. So things are normalizing a bit. I think that's a good sign. What we have been doing with our portfolios is looking at that growth exposure, and we've been doing this, right? Seeing that growth has had a nice run and trimming those gains from growth and adding to other areas of the portfolio, kind of setting us up for this next part of the cycle.
All right, Frank, your wisdom on this one.
That all being said, we also have to look a little from a technical perspective here. We've had quite a run, as Mike suggested, and we haven't had a correction in memory I think it's been a year or two since we've had a pullback of 10% or more. We're due, and maybe it'll come with the spring rains. Maybe there'll be some geopolitical event to set it off. Clearly, the conversation last week didn't do it. The AI thing the week before didn't do it. But the market's been choppy. To me, it's looking like it's just waiting for a reason to go down 10 or 15%, which I think would be healthy if that happened.
So, with having said all of that, fourth quarter earnings didn't really have much of an impact on the market, or did they?
Yeah, I think you saw it did for some companies. Like Google had sold off a little bit. McDonald's reported today. They disappointed, but the stock's up a little bit based on, I think, expectations going forward. I think what you're seeing in terms of some of the Mag 7 that Shannon pointed out is expectations for these companies are still sky high through the roof. I mean, Google reported very, very solid earnings growth across the board. Revenue was very strong, but their stock sold off because investors are expecting perfection right now in a lot of these companies. And if you don't hit it, then your stock suffers a little bit. And so, to Shannon's point, it does make sense to broaden out your exposure a little bit outside of those top 10 stocks in the S&P 500. Those top 10 stocks make up 35% of the S&P 500. So the S&P 495 only make up 65% of the broader index. So it does make sense to start broadening out your exposure within those large cap names, I believe.
Yeah, Stacy, there's one more point to make here, I think, for viewers, is that we really need to stay focused on the long term. To what we're all saying here today is markets are going to be a bit choppy or a bit volatile. So if you're a long-term investor, we will get through this. We've seen these periods before, although we haven't seen the 10% corrections that we normally do, but we know what volatility feels like. For those that maybe are taking income, what we're doing here at our firm is making sure that we have enough cash on the sidelines that's completely insulated for the next 6 months, no matter what the market does. So I think those are important points to note to the viewers.
Okay.
Is that cash what you're going to use to spend, Shana? Or is it what I would call dry powder, looking for opportunities?
I think it's both, Frank. It's both. If a client is taking a monthly distribution, making sure that's available, but also absolutely to your point. So when we have these dips, it creates opportunity for us to go in and make some buys.
If the 7 or 10 companies, whatever it is, that make up 35% of the S&P 500, if they are, if I'm hearing you correctly, are they? Maybe I'll just ask the question: are they overpriced?
Well, I think overpriced. It depends. If they can grow, if they're expensive compared to the markets, right, from a valuation standpoint, but their earnings growth is projected to be higher and better than the other 495 companies in the index, or 490. So if they can grow into that earnings, and if they can grow into that valuation, then they're not overpriced. But you see, remember a couple weeks ago when DeepSeek came out, from the China's AI version of ChatGPT, more or less, the market sold off a couple percentage points, and that was really driven by Nvidia's fall in that day. But there were 350 companies in the S&P 500 that were positive on that day, yet the market was down. Okay. So you've really become tied to the market's really become tied to the performance of a subset of the S&P 500, which is something that investors need to be cognizant of.
So it's a market of, it's not a stock market, it's a market of stocks. And if you don't have to own these volatile stocks if you have a reasonable expectation of earnings. If you want to just merely make 8, 9, 10, 12%, you can avoid these volatile things and own good companies that aren't necessarily affected.
Yeah.
Okay, good. Well, Michael brought this up a moment ago. The Trump administration has already raised tariffs on some countries. At the same time, his new Department of Government Efficiency has been eliminating jobs and looking for basically government waste. So, Frank, with all of this going on, as an investor, should I be scrutinizing what is happening, or what is happening there make any difference at all?
I don't know if scrutinizing is the right word, and the reason is it changes by the minute. And I think at this time you need to pay attention to it. I'm not making any changes as a result of all of this stuff. but I am watching it very closely because whatever actually happens will have an impact. But understand, many of these moves are being blocked by courts and Congress because they're unconstitutional. The the whole the whole check and balance system is coming into play here, and right now we're in a power struggle more than anything, where the White House wants to capture more power than they've had in the past and diminish the other two branches. This happens from time to time. Trump loves William McKinley. He tried to do the same thing. Teddy Roosevelt did it to a degree. Of course, Franklin Roosevelt did it to a large degree, but we were under a great economic stress at that time, so I think they gave it away to him easily because things had to happen. During war, this happens, and right now, Donald Trump is trying to, I don't want to call him what everybody else is calling him, but he's trying to gather more power into the White House than it's had recently. So
A lot of people
no, I'm
are
not
kinda-
making changes, but yes, I'm paying attention to it because it will have an impact on some industries.
Well, to your point, and not necessarily in defense, but to your point, some presidential power, if I'll call it that, was diminished after Watergate. Congress stepped in and made some changes there, and so that's now there are attempts to try to gain that back again.
These things are like all pendulums. They swing around and it'll get way out to one direction, then it'll come back, and it's just evolution in the way that, fortunately, our country has had this happen before and we've survived it. Hopefully 250 years isn't the magic number, but we are getting a little long in the tooth as economies, unless you want to start the clock around World War I, when we really became a major power.
Anything to add on this, guys?
Yeah, I mean, I agree. I think just paying attention and staying close to it, whether it's tariffs or, the government deferment with the job situation. I mean, everything's so fluid. It's changing too quickly. It's like last Monday, this whipsaw idea. So not making any knee-jerk reactions, but certainly paying attention to data like jobs numbers. Tariffs is obviously important, but it's too soon to make knee-jerk reactions right now.
Yeah, I wouldn't make a knee-jerk reaction based on Doge at all. I mean, frankly, I like the fact that we're going through the government balance sheet and the budget and seeing what makes sense to keep and what doesn't make sense to keep. I think that's long overdue, regardless of how you feel about Trump and Musk and whatnot. If it could have been Biden and somebody else to do that, I think it makes sense to do it. But from an investment standpoint, which is what we care about on this panel, it's too hard to make an investment decision based on what might happen from that standpoint.
All right.
Is it time for me to tell a story?
Sure,
Oh,
go
boy.
ahead.
Back in 1975, when I was very young in this business, I was having lunch with my father, the CPA, and I was reading very carefully the congressional debates over what became the Tax Reform Act of 1976. And I asked him what he thought of it. And he said, "Did the president sign a new tax law?" And I said, "No, they're talking about it." He said, "Don't waste my time. I'll read it when he signs it."
Yeah. And that's
So-
a good approach as far as your investing goes.
Yeah. When there's actually something there, and not just trial balloons being thrown around, which is what it looks like to me.
All right. Shana, there are a lot of economic reports, and a couple of them deal with consumer sentiment. So how much attention should we pay to those, and can those indicate how to handle certain consumer stocks down the road at all?
Okay, so consumer sentiment, I think this is really important for everybody to understand, is it's a gauge on how people feel, right? And if people are feeling uncertain, we've seen that the last 2 months, and I have a really fun chart that my colleague Christian Miller shared with me this morning. This is 1 year inflation expectations by party, not to get political. But the Republicans have said that they thought inflation was around 3.7 and they expect it to go to 0. And the Democrats had inflation at about 2% and expect it to go to 5.1. This isn't an indication of how people feel. We don't make investment decisions based on how people feel. we do need to look at the data. So it's interesting when consumer sentiment is down, yet we still see positive signs with consumer spending. So we have to watch the data of what consumers are doing, and data is very important to our business. That's when we do maybe make some moves within our portfolios. So let's stay focused on PPI, CPI, manufacturing. This week we get consumer spending number report comes out this week. So yes, data is important, but don't get hung up on how people feel. This is an uncertain period of time, and that's not how we make investment decisions.
Well said, but I do follow one thing.
Okay.
Investor sentiment I follow. When they get particularly bearish, I get particularly bullish because the American Institute of Individual Investors, they put that chart out every now and then. They are often exactly backwards.
So you're contrarian as far as that particular.
So I tend to be a contrarian when it comes to that, and that is how people feel about investing, though, not the economy.
Yeah.
It's harder to be a contrarian than it's easier said than done sometimes, Frank. So I applaud you for that, because when investors are very, very bearish, I mean, things are going usually not in the greatest of ways in the economy right now. So kudos to you for that, for sure, because I'm sure that pays off in the long run more than not. But to Shayna's point, those inflation numbers are rather humorous on both sides. I mean, because I don't think inflation is going to zero, and I don't think inflation is going anywhere close to 5.5%.
And that was on Bloomberg, by the way.
Yeah,
So it was like legit.
But the economic numbers that we pay attention to, Stacy, because I think that was your question, are I still think the most important stuff right now, given the economic landscape we're in, are the actual inflation numbers that come out. We still at Fragasso believe that inflation is going to remain a little bit stickier than probably the Fed believes, and maybe some other pundits believe. I think it ramps up higher, closer to that between 2.5% and 3%, which means that so long as the economy remains strong, which the economy we think is still pretty strong, the likelihood of the Fed being able to cut 2 times this year, which is what the markets are predicting, is probably dissipating, and it probably won't happen. And the other thing we look at is the unemployment rate. You know, if jobless claims, they look pretty good, but if that unemployment rate and jobless claims continue to tick up, I think that's a little bit of a bellwether to say the economy is not nearly as strong as we might initially have thought. Now, again, we're sitting here at 4% or so, a little over 4%, I think, unemployment rate, which is historically very, very, very good. So I think right now the economy looks really good, but inflation, I think, remains a little bit more elevated than the Fed's going to want.
One thing on the jobless numbers, Mike, I read over the weekend that jobs and job openings are somewhat imbalanced right now, which if that is true, which I can't remember where I read it, so I'm not going to say it's definitely true. But if that is true, that's the first time that's been the case since before the pandemic. We've had more jobs than we've had unemployed people. And if we're even now, that's a very interesting dynamic, considering my landscaper, I understand my landscaper in this development I live in, the guy that does it all, he can't get his immigrants this year because they've shut down the borders to some degree. And I hear that's a problem all over the place. And that is going to be interesting to see how that plays out with unemployment as well as the economy.
Shana, you indicated that retail sales are going to be released. How important is that in the overall picture?
I mean, that's pretty important. I mean, we want to see what habits are, looking at how consumers are spending, because it's a big part of GDP, right? So we're 70% consumer driven. So it's positive for us to see consumers out there spending. Also kind of looking at their savings rate. You know, early in COVID, savings rate was very high. Yes, it's come down, but it's still somewhat steady. So I think these are all really important key measures to be looking at as we are managing client portfolios.
You mentioned Bloomberg. I saw this one over the weekend, and basically is that consumer debt surged by the most on record in December, reflecting massive increases in credit card balances and non-revolving credit. Is this a concern as far as any investment goes?
Yeah, we do watch the debt levels. You know, how are people making choices to pay bills, right? With inflation being still somewhat sticky, are they making choices not to pay car payments or pay credit card bills? That, you know, that's a warning sign. That's really what we're trying to figure out, is the economy contracting or expanding, and those signs might, you know, shed some light on what growth will look like this year. And if growth is, if we see signs of it starting to slow, then that would give us cause to make some changes in portfolios.
In what way?
Well, I mean, we've already kind of taken that measure from reducing our growth, just knowing that we've had 2 years of growth. Even if you're looking at indices of growth versus value, you see that reversal already, right? We're seeing it with the Mag 7, and those returns are coming down. So making that shift from being more overweight growth to maybe other areas of the portfolio like value, companies that pay dividends with strong balance sheets, that sort of thing.
The thing that I've noticed is, we don't have the John Templeton types around here anymore, the all-star manager that everybody puts a mic in front of. But back in maybe it was the 70s, John Templeton was heavy in cash, and somebody asked him if this was a tactical decision. He said, no, I'm just having a hard time finding things that I think are worth owning at these prices. And I think in money management, that may be happening, where we're getting a little more cash, because when we take profits, finding a place to reemploy that money is not as easy as it once was. Things are, as Mike said, they might be a little expensive. Maybe.
All right. Well, I want to thank Michael and Frank for being with us, and Shana, a special thank you to you for coming on for Coghill Investment Strategies. We appreciate your time here, and we will continue our look at investing in the economy in our future editions. And I ask that you hit the subscribe or the like button on whatever platform you happen to be using, listening or watching this. But for right now, thank you for joining us, and we'll see you the next time for the next edition of The Bull, the Bear, and You.